talk about 401ks and retirement in general. What I'm going to say has to apply to Social Security, Roth IRA, pensions, things like that. So there's a lot going on right now talking about Medicare, Medicaid, Social Security. So thought I'd go into a little bit about 401ks just in case you have no idea how retirements work in this country. So let's reshare that screen. Why is it not sharing? Okay. So 401k investment basics. We're going to cover a little bit of a history, what index funds mean, which is the easiest way to invest, how compounding interest works, the time in the market, why downturns aren't bad while you're investing, and what people are calling Social Security a Ponzi scheme. So we used to have little village type communities, and your family would care for your elderly, disabled, incontinent, and your village would help it. You know, the saying that it takes a village to raise a child. You have your village, and then, you know, beyond that, even the Old Testament Bible talks about how widows should be taken care of by basically what we call a deacon now. The church should be taking care of the widows and the poor and the children who can't take care of themselves. You know, you take in orphans, you adopt orphans, you don't put them in a home with other orphans and let them, you know, rot there, for example. So the effects of industrialization, people moving into apartments, people not owning their own houses, people not living in family estate housing, or manors owned by lords, and not living on their property, people living by themselves kind of left those unable to take care of themselves in the lurch. And this was the industrialization, which is like the 1890s through the 1920s. And that led to the Great Depression because, hey, stock market, that's exciting. Look at how you can make money and like by not actually doing any work, which overinflated the value of things. You know, most recently we saw that in the housing market in like 2008 through 2011, where the housing market was a bubble because they were giving loans. They were giving bad loans to anybody. They were giving loans with interest rates that were way too high to anybody. So in the 30s, after the Great Depression started to settle down, there was talk about, you know, socialist kind of movements, and FDR came up with the New Deal, which was kind of like a stopgap. So part of that was the Social Security Act. I only have a really basic understanding here. I'm not going to try to go into politics, but from what I understand is part of what it did is it appeased the socialists enough to where they couldn't say that we need to like end capitalist democracy altogether. You know, a lot of the New Deal, it raised taxes to pay for it. It had the government spending money to do things instead of local communities. So now you have federal roads, you have state highways, you have interstate highways, you have federal roads, state roads, instead of each community building their own infrastructure. You have, you know, utilities, electricity, water, things like that being kind of overseen by the government, and less like each little small community had to figure it out on their own. So part of that was the Social Security Act. Basically, after the Great Depression, families didn't have enough money to support their elders. They barely could support themselves. So the people that are not in the workforce needed to be taken care of. You know, I don't know about churches at the time. You know, a lot of time churches ran orphanages, hospitals, basically the care of the people at some point in the history. But anyhow, the FDR, Franklin Delano Roosevelt's The New Deal, had a lot of public service stuff. And it was basically because the combination of the Industrial Revolution and the Great Depression made it so that there were a lot of people that were uncared for and uncareable, couldn't be cared for. So the federal government stepped in to avoid a crisis, basically. And then pensions were first issued by the military. As kind of like a, a lot of military veterans get injured. They maybe can't do the type of work that a fully able-bodied person could do. So there was a retirement pension for military. And then the railroads in the 1800s, and then the Industrial Revolution brought the idea of pensions to a lot of other businesses. Now the problem with pensions is that the companies needed to fund them. So if the company's insolvent or losing money, they can't put money into their pension, and then the pension can't pay out to the pensioners. The idea is that the new employees or the new production of the company will always be growing, so they will always be able to put, let's say they're putting 5% of their gross profits, of their gross proceeds into pension, 5% 10 years from now is going to be greater than 5% today. So as they have more people retire, they're going to be putting more into the pension fund because they're going to be bigger companies making more money. You're constantly growing. Stagnation means your stock prices aren't going up, and then you're not keeping up with inflation, and that ticks off investors. So every company needs to grow until it's too big to do anything else. And then you start paying dividends instead of start worrying about your stock prices growing. So that's the idea, and that's why some people may call it a Ponzi scheme, right? Is you're requiring more and more people, and that worked great in the 50s. That worked when the baby boom, right? When all the baby boomers went into the workforce in the 60s. Is that right? They came back in the 40s. 20 years later, 60s and 70s. All the baby boomers went into the workforce in the 60s and 70s. There's a lot more people paying taxes. There's a lot more people contributing to the economy. There's a lot more people paying into whatever thing requires people to pay into. So as the baby boomers retire, and the birth rate the typical family had less than 2 children per parents, there are now not the the growth of population to support a large retirement community, if that makes sense. So that's a little history. Good or bad, it is what it is. The way 401ks are now are still better than pensions. So again, if a company became insolvent, all of their employees that were expecting a pension check that maybe had nothing to do with the company because they've been retired for 10 years, all of a sudden don't get a pension anymore. There's not like a guaranteed escrow for that. So when you go into your 401k account or your IRA account or your 403b or whatever, you can see personalized performance, and you can see little charts like this. This is the 10-year stock market average, Dow Jones Industrial Average on the left, the S&P 500 in the middle, and the NASDAQ Composite on the right. So if you can see the 10-year performance in all of these looks very similar. When one of them's up, they're all up. When one of them's down, they're all pretty much down. So this is indicative of the stock market as a whole. Okay, so individual stocks are volatile. The stock market as a whole represents the U.S. economy as a whole, with the NASDAQ specializing in tech sector. You can buy an index fund into these types of things. So you'll see things called S&P large cap, that's the S&P 500, S&P mid cap, that's a different set of stocks of companies. That it's the top one stock of every company of the top 500 stocks that are less than $1 billion or whatever. I don't know where large cap and mid cap gets split, but it's that. This is the top 500 net worth companies on the stock market. One of each of those stocks. What's the total combination of that? Now, one of each stock. When some stocks are going for $1,000, and there's 500 companies, you can't put in $400,000 to buy one of each of those stocks. But what happens is you get thousands of employees that are all putting in $40 into this, and then the hedge fund, the index fund, buys one of each stock, and they track that price. So they're providing a service there by bundling stocks and letting you buy a part of a fund of those stocks. So that's how index stocks work. So thousands and thousands of people are all buying the same index funds. I only have 21 options in my retirement account that I can pick from. They're all index funds. I can't buy individual stocks in my 401k. I can only buy funds, and there are different funds. There's a BlackRock investment firm advisors pick fund, stuff like that. But basically, what you're going to look for is you're either going to look for a mass market fund, or a S&P 500, or an S&P mid-cap fund, something like that, and that's going to track with the stock market. So that's the easy mode. That's the not like, ooh, international small companies are going to get a big boost because of this trade agreement. Let me switch to that for 6 months and then switch back out of it after it tops out. This is just, if you're going to do one thing, just put it all into here, or split them up, pick 10 and split them all up even, however you want to do it. I'm 60% in S&P 500, and I'm like 10% in a couple other ones. For the most part, people that pick stocks, 90% of them, somewhere between 90 and 98% of them, don't outperform the S&P 500. These are just the largest, strongest companies in the country. The rest of the companies in the stock market are smaller and less stable and more volatile. And people that pick stocks, honestly, just don't do better than the whole stock market as an average. It's very unlikely that you beat that average. So that's why index funds are good. Okay, compounding interest. Your annualized amount equals your principal, your starting value, times the interest rate to the power of your time. So if you're compounding every month, it's going to be, let's say you have a 5% interest rate. Well, every month that's going to be 0.008 times the number of months. If it's 5% a year, it's going to be 0.05 to the power of one year, right? So your ending amount equals your principal starting amount times the interest rate to the power of the time, the number of times you're compounding. This yields a geometric growth, which is, it looks like exponential growth. There's a slight mathematical difference. For all intents and purposes, when you're talking to a layperson, they're the same. You can say this is exponential growth, and you can see this is the stock market from 1900 to now, present day. Exclude this giant bump in the 70s and this dip here in the 90s. If you were to smooth this out, that is exponential growth. And it will continue to be exponential growth because that's just how interest works. So your time in the market is the most important thing, because do you want to start here? Well, I hope you can see my mouse. Do you want to start here at this peak and average out to this 45-degree line? Or do you want to start back here where you can grow the whole exponential curve? This is an actual performance from one of my stocks for 2014 to 2016. The reason I don't have more current is because after this it's a flat line because I left. But the most important thing is your time in the market. As you can see at the end of here, I'm actually minus my cap. the little red section here is my total value is actually less than the gray line is the money that I've put in, my contribution and my employer contribution, and the blue line is the current value. So you can see I'm above that line. I have a higher value for most of the time, except for right here in 2016, I'm below the amount of money I put in. So I actually have a loss. Like if I had just put that into a savings account, I would have been ahead at this point. But what happens is on the dips, every time there's a dip, it comes back up. Case study. If you invest $100 30 years ago at 7% interest, which is conservative for the most part, that's what people say is like a conservative 10-year average, but the actual average over 40 years is more like in the teens. But that gives you $700 by investing $100 30 years ago. That's a 600% growth. If I invest $100 every year for the past 5 years, that gives me 715, so almost the same, but now I've put in $500 to get 700 instead of $100 to get 700. Now I know you got to account for inflation, so this 100 is really like I put in 250, but it's still, the stock market has outperformed inflation rates on average. So how early you put that money in, how early you start investing into your 401k, how early you get your employer match, your very first job, do your 401ks. Okay, now why you don't worry about little dips and drops in the stock market, right? So here on the left, I have a trend line of saying this is actual stock market data, only 1 point a year, so not like month to month, but only 1 point a year. But this is actual stock market data. It averages about 18% from 2014 to 2026. So 2015 to 2025, so a 10-year period, 18% interest. You can see a little bubble here before the pandemic in the middle of 2020, and a big dip here in 2021 to 22 because we had to recover from an economic shutdown, right? So there's a pretty big dip. There's it's at 4.3 down to 4. That's about a 10% loss, right? On average, I'm looking at 18% rise there. But if you draw a straight line, if I put in money once a year and not put in money just at the beginning, if I put in money at the beginning, it's an 18% increase, right? But if I put in money once a year up to this point, the money I put in 2015 has a 19%, the average. The money I put in 2016, even though 2015 to 2016 looks like I never made any money, the money I put into 2016 has a 21% increase. There wasn't a dip, but it was lagging, and then it caught up. Most of the catch up here is in 2020 to 2021. And you can see that 2020, I got a 27% return. The money that was put in 2021 only has a 21% return, so closer to the average. But then the 2022, at the bottom of the dip, has a 30% return on investment. So that money, so what happens is, they always say, sell high, buy low, sell high. When you're constantly investing into your 401k, when the market starts dropping and the market is bad, at some point you will be buying at the bottom of the dip. You will be buying, if you buy every month, you will be buying low. At some point you will always be buying low. The stuff that you lost between 21 and 22 will recover, have recovered, it goes back to the average, but the stuff that you bought in 2022 has even better return on investment. And the stuff in 2023 has an even better return on investment. And then we drop back down. The stuff in 2024 at the top, we're getting to the top of the curve. The next 2 years are going to be slower. But if you're constantly contributing, that means when it's low, you're always buying low. I know you're not selling high. You're going to sell when you're retired. But that's why you shouldn't panic when your retirement drops. Assuming history repeats itself, it will recover, and you're buying into it when it's dropping, which means you're buying low, which means eventually you can sell high out in the future. Okay. Now, why Elon Musk has called this a Ponzi scheme. The stock market's affected by demand. Basically, none of those companies are worth what their market capitalization is. The market capitalization is how much money people have put into those companies. So, since we've switched from a pension to a 401k, every full-time U.S. employee is encouraged to invest into the stock market. That artificially inflates demand. So you're artificially stimulating the stock market price. Now, why do the rich people love this? Well, you have every poor person inflating your stock market price, your investments. So that's how we're achieving those 18% gains, is because everybody has enough free cash. Everybody's making sure they have enough free cash to put in to the retirement accounts. So we are artificially inflating the value of the stock market by increasing the demand, by making sure that every full-time employee contributes to the stock market. And why is that? Because it's got better return on investment than anything else that you can do, better than CDs, better than bonds, better than, well, there was a real short period of time recently where the bonds were like 10% for a bizarre reason. Better than some real estate. Like, the stock market is the best return on investment as long as this continues, right? Apple has $1 billion not because they've sold $1 billion in products, but because they've sold $1 billion in stocks. As soon as one entire generation decides that this isn't the right thing to do, stock prices won't keep up with inflation because they won't be artificially held up. They will drop until things stabilize, and then they'll start rising with inflation again. They should never lag behind inflation, but at some point, if the new employees don't participate, same thing with the health insurance, right? The reason the health insurance exchange works, and the reason they're taxing you, giving you a penalty if you don't buy health insurance, is because young people are cheaper, and they need everybody to contribute so that the pool mitigates the risk, right? If you have only risky people buying health insurance, then you're going to pay out on those risks, and it's going to be more expensive for the insurance companies. If you have everybody participating, including the non-risky people, the non-risky people are losing out a little bit because they're paying into insurance that they're not using, but it enables the system to be risk averse and know what percentage of people are going to cost money versus what percentage of people are going to make money. And that's how the health insurance marketplace works too. So the stock market, as long as people keep investing in the stock market, and right now the US stock market is a much better investment than any other market around the world. Europe is much more conservative with their growth. They're much more intent on keeping the wealth than gambling on creating more wealth. So they're very risk averse. They're very status quo. So their markets might beat inflation, but probably are going to track a little closer to inflation than the U.S. stock market. The U.S. stock market is a little more volatile, but it also has the opportunity to pay out a lot more. This is still better than insolvent pension plans, right? You're just like health insurance. You have more people contributing into the same retirement fund, the stock market, and there's a shared benefit of keeping that afloat, right? Everybody that's invested has an interest in not crashing the stock market again. So it's definitely better than individual pension plans. It's safer, it's more responsible, and it takes the because it's in this big complicated stock market system, which has its own rigging problems, but it doesn't allow small numbers of people by themselves to kind of rob the system and take money away from people that own it. Thank you for listening.